I'd like to welcome to the stage a contributor to the magazine, Michael Collins, to talk about a very compelling topic for our group, mergers and acquisitions. Michael, please.
Thank you. Thanks so much. Well, good morning, everybody. Great to be here. Hope everybody had a great evening last night, and we're looking forward to a strong last day of the conference. Appreciate the opportunity to be here and our partnership with ProSales Magazine. I want to go ahead and start off in the keeping of the theme of mapping the future with navigating mergers and acquisitions. Our panelists scarcely need introduction, but we'll introduce them shortly. Before I do that, I do want to walk through a few statistics that we think are relevant to the pace of M&A activity in the market right now. And we'll just move through those relatively briefly. We do think they're important in giving a pulse of the market. This is a set of data that ProSales puts together. We supplement it with information that we gather out in the market. And so this is very much a living collection of data. The next time you see these numbers, even the past years, will be a different number of transactions. There will be more of them. We're continually finding and identifying transactions that weren't in the database because we think that M&A activity is just one of the key measures of activity in the industry. And so we like to do our part along with ProSales and bring you that data and that information. So as you can see, this is acquisitions by the number of deals, meaning irrespective of whether it's a 20-location business or a one-location business, one company is one deal. And you can see that deal activity by number of companies peaked in 2015 at a rate at that point of roughly a deal every 4 calendar days in this industry segment. I'm not aware of another industry where there's such a rapid pace of consolidation going on. We've had a slowdown of M&A activity, but as you can see, it has slowed down to roughly a pace of a deal per week, which is still a very respectable pace and a very brisk level of activity. And it's one that it's highly unlikely would just stop overnight or go away. So there's every reason to believe that the next couple of years will continue to be strong for M&A, and it's certainly, as we'll hear from our panelists, a busy time in the market. Taking a look at 2018, who were these companies that were acquired? 70% of them, roughly, were dealers and distributors. And as you can imagine, lumberyards tend to acquire other lumberyards, and specialty dealers that deal in roofing or drywall tend to acquire specialty dealers that deal in that segment. Lumberyards being the next most common segment. There's always activity with manufacturers. We do count truss manufacturers as a manufacturer, but you'll also see some millwork manufacturers and things like that, where a supplier just makes the decision that they want a captive supply of that product, so they acquire the company rather than take their chances out in the market. Openings and closings is another key thing to track. That obviously we track by locations. Fortunately, in the industry right now, companies by and large aren't going out of business per se, but companies do rationalize locations when they decide, especially as we get later in the cycle, you know, if this isn't profitable right now, what's going to happen if the market goes soft in a few years? It'll only be worse. So what we've seen is that over the last few years, openings have drifted downward and closings have drifted upward. And that's what you'd expect at this point in the cycle. People are rationalizing and making sure they've got their pieces on the board in the best possible spots as we move forward in the market. So then we take a look and we say, okay, well, where is this activity happening? Locations being acquired, locations being opened, and locations closing. Clean sweep across the top, California. California is a place where you're seeing a lot of acquisitions, you're seeing a lot of new openings, and you're seeing a lot of closings, meaning, again, people wanting to just make sure that they're in the right spot in that given state. Interestingly, the locations acquired is a mirror image of the 3 states that were expressed yesterday in another presentation as being the 3 strongest states for housing starts, California, Texas, and Florida. So again, people are going in and acquiring locations in those areas rather than taking the time to greenfield an operation and grow it from scratch. They want to step right into the market. Now, the top buyers in terms of activity in the deal world, which again is just sort of an idea of who's out there, very active. By our statistics and the statistics provided by the companies that are out there in the industry doing acquisitions, US LBM and Foundation are the 2 top buyers for the 2015 to 2018 period. GMS, SRS, other companies doing a lot of acquisitions, and it's no coincidence that all 4 companies up on stage are represented on the list because we wanted to bring you the most active acquirers in the industry. Now, this last little bit that I want to share with you is very interesting to me because if you look at it, there were 7 buyers in that 3-year period that did more than 10 deals each. And those are a lot of the companies that we've just talked about. Some are on this stage. And those are very active buyers out in the market. But the next tranche of buyers bought between 3 and 9 companies. So again, that's a company that's very committed to acquisition strategies. When you've bought in a 3-year period, 4, 5, 6 locations, that doesn't happen accidentally. That's a focused area of yours. 2 deals, a baker's dozen of those. There were two deal buyers, there were 13 of them. But the really interesting thing is this last category, 84 companies in that 3-year period bought exactly 1 company each. So what it means is that there's a very good chance when a company gets sold that it will not be one of the most active buyers in the market that acquires it. It may be that next strategic buyer in the next market over. So don't ignore them is the point. If you bring a company out to market, the buyer may be in your backyard. We'll go ahead and we'll start here with Jim. And if you could just work your way across and introduce yourselves, and since this is an M&A focused session, if you could just give us an idea of your sort of M&A credentials, if you will, deals, numbers of deals, however you want to express it. And again, thank you all for being here. Appreciate having you. So,
sure.
Jim,
Michael, appreciate it. Jim Drexinger, CEO for American Construction Source. Relatively new organization with respect to acquiring these businesses, but deep experience in the space, 35 plus years in building products, 2 experiences on the manufacturing side with Armstrong World Industries, floor carpets and ceilings, and then NIBCO, rough plumbing products, and then with Woolsey North America, almost all of my efforts supporting stock building supply. So we put the platform together in late September and have started to build that out, and very, very, very pleased with the businesses that we've brought on.
thank you.
Good morning, Dave Flitman, President and CEO of BMC. New to the industry, new to the company, obviously been with the organization for about 6 months. Most recently came out of the food service distribution industry where I was for about 4 years, but spent almost 30 years in and around the chemical industry, 20 years at DuPont early in my career. I've had a lot of M&A experience through the course of my career. Most recently at PFG where I was in food service, we did 9 acquisitions over the course of about 3.5 years. And we've already done 2 here this year at BMC.
Great, thank you.
Good morning, my name is Steve Swinney, CEO of Kodiak Building Partners. We launched Kodiak in 2011, done between 20 and 25 acquisitions since that time.
Good morning, LT Gibson, CEO of USLBM. I think we've done 54 deals since 2009. We consider ourselves more of a people-first company. I know that sounds odd for an acquirer like we are, but we think there are certain things that are great about being a large company, and there are certain things that give a real advantage of it being a smaller company. So we try to maximize both of those.
Great. Well, welcome all of you, and thank you again for being here. We're going to try something new. We've identified some questions that I felt were indicative of some misconceptions that were out there in the market about different aspects of the mergers and acquisitions process. Now, we're going to treat this part as kind of the lightning round, which is not to imply that there are any prizes. There are no prizes, but it will be that we will move through it as quickly as possible because we want to get to the other questions that we've taken. And at the end, I'll have a number up there that you can text me questions that we'll then answer during the session here. So have your cell phone ready toward the end of this section, and you can start texting us questions. Now, so the first question, and the responses to these, I should say, when I say attendee responses, we took a poll that 30 or so of you participated in prior to the conference. It was sent out in one of the emails by ProSales, and we got some responses back. Now, I don't know if a Gallup statistician would say that's statistically relevant, but it's at least interesting, and it's got to be somewhat indicative of the beliefs of the people in this room. So we'll give you a second as I ask each of these questions to sort of formulate your own answer, see what you think the answer is. I'll tell you what the attendees who responded early thought it was, and then while the panelist answers were largely consensus-oriented, they were not unanimous. I'll just say what the consensus answer was, and then we'll have maybe each time one panelist chime in of why they said that, they felt that way, or if one of you want to take the counter position to one of these and say, well, I think I see it differently, because some of you did have a different opinion. So the first question was that the typical discounted cash flow model remains the primary methodology for valuing a business. True or false? Discounted cash flow, primary methodology. The attendees were roughly evenly split, a good portion of them believing that that was true, that it was true that the DCF was the most current or the best model. The panelist consensus was that that is false. That is not the prevailing methodology. And Steve, why don't you address.
All right.
If you were on the false side of that, or you could take the counterpoint if you want to bring DCF back.
Well, so I actually would take the true position on that. That being said, when you think about how a company, or at least I know how we go about that, there's 20 different factors that go into developing that DCF analysis. And it's not just about the numbers and the forecast. It's about the people. It's about that organization, that brand, the value you think they bring, and what you think that team with your support can do in the future. So I'd say it's true for us. That's how we form our basis, but there's a tremendous amount of non-financial analysis and thought that goes into developing that.
I would just agree with what Steve said, and I would just add, if you think about how to value a business, looking at discounted cash flow takes into things other than the P&L, right? It takes into account working capital, what you have to plow back into the business from a capital expenditure standpoint, and look at all that holistically. So I would take the true side of that one as well.
Okay. All right, good. Well, moving on to the next one, an EBITDA multiple-based valuation, which, in my humble opinion, is the prevailing methodology that we talk about, includes the value of real estate. So if you get an EBITDA-based valuation of your business, does that include the value of your real estate or not? Largely, people thought that was false. About 1 out of 5 respondents thought that was a true statement. Consensus among the panelists was that was false. Yep. Jim, do you want to?
Sure, and we're certainly on that side of the ledger from that standpoint, especially in this industry. You know, these multi-generational businesses, you know, very often the real estate, you know, is still in the hands of the owners and the family from that standpoint. So when we value the business, we do it, you know, largely on EBITDA. We look at DCF as well, but triangulate on that. But on the real estate side of the equation, that's typically a consideration outside of the value of the business.
Perfect, okay. So when using an EBITDA multiple-based valuation approach, the seller can usually negotiate a separate payment for the working capital. So you get your EBITDA valuation, and then you add to that your working capital value. True or false? The respondents from the audience were roughly split. Our panelists, the consensus was that is a false statement. LT, do you want to take that one?
Yeah, I think, you know, again, there are a number of things that go into, you know, any negotiation. You know, there's always, if you bought a lot of CapEx in the last few years that maybe is above the industry norm or above your norm, it'll certainly be taken into account. Just like, you know, I don't think, you know, EBITDA multiple is not the right way to value a business. DCF's not the right way. It's really that fulsome approach to look at everything. You know, the team, the synergy, the opportunity. And this is the same way. You've got to look at the value of the assets, what you're going to have to put into that business. Obviously goes into the DCF, but I think in this case, if you've gone above and beyond, it's something that can be allowed for, but it's not usually negotiated outside. It's usually just taken into account.
Perfect. Okay. Buyers, and this is a little bit of a tough because it's got a usually in it, which is a little bit subjective, but buyers usually rely on headcount reductions and or closing facilities in order to hit their projected returns. I think it's a pretty common belief out there that is true. True or false? They rely on headcount reductions and closing facilities. 3/4 thought false. 1/4 of respondents thought it was true. Our panelists replied that they thought that was false. Mm-hmm. Steve, why don't you take that one?
Well, yeah, I mean, I think particularly in a recovery and growth phase, as we've been in for the last several years, buyers are looking to grow and improve their business, not whittle away at it. I mean, we've all, I think everyone on stage here is in this to grow a business. You don't do that by getting rid of key people that make things happen every day, and you don't get rid of that you don't do that by having less outlets to serve your customers. So I think across the board, that's not what this group of people have been about in operating their businesses over the last
It's a kind of a popular notion. Goes back, I think, even to the Gordon Gekko view of, you know, buying companies and chopping them up, and it's really not a methodology anybody utilizes out there. Interestingly, after an acquisition, the buyer usually pulls all of the administrative functions, payroll, banking, AP, AR, up to the corporate mothership, pulls them out of the branch or company acquired, and pulls them up to the corporation. True or false? Respondents thought that was largely true. Panelists felt that was largely false. Who's LT? You've got a good model for this. Why don't you take that one?
It's a people business, it's a relationship business. I think the idea that everything immediately comes to corporate, is largely false. I think there are things you can do on the synergy side. There's certainly, advantages to being part of a big company. You get better technology. You have buying power. There are certainly benefits. But the idea that you need to eliminate anybody, you might repurpose some of those. But in our business, you usually don't have a person that's just in charge of this or that. What we try to do is free up some of that time so they can work on different projects if there are things that are better done at the corporate level.
It is correct treatment to add back the full salary of the owner of a business regardless of their day-to-day role at the company. So you figure out your EBITDA, you add back the owner's salary, that's your adjusted EBITDA. True or false? Attendees felt that was, 2/3 of them felt it was false, 1/3 of them felt that it was true. Our panelists' consensus was that that is false. Dave, do you want to take that one?
Sure. I think, a big portion of what we look at in terms of acquisitions is what that company and organization is built, and that's largely dependent upon the people. I think it depends on the role that the owner is going to have going forward. We look for opportunities for the owners to stay. We want that leadership to stay in place. So I think it depends, but if they're going to stay in place, we want to pay them.
Right. Okay. If a company owns its own real estate, and this one maybe there was less difference of opinion about, it's typical for the buyer to use what's called a negative add back. Add backs can go both ways. They can help EBITDA and they can hurt EBITDA. A negative add back to match the effect as if the company was renting the real estate from a third party and therefore at market rates. True or false? Attendees thought that was largely true, and our panel said that was true. Jim, do you want to cover that one?
Sure, happy to. Again, to my comments earlier that, the majority of the businesses, that are in the process of selling are family-owned businesses. They own the real estate. Some burden their businesses with market rate rents, others do not. But in the go-forward environment where the acquirer would be part of it, we absolutely would, true up, if you will, the P&L to represent the fair market rent value.
Perfect. Okay, good. Well, so that was that's the conclusion of the lightning round. For the rest of the questions, we'll be asking all the panelists to comment on them. You've got a number right there, which is a temporary number for the conference, just to make sure everything's coming in one spot. You'll see me up here using my phone, hopefully, to gather these questions. And so you can start texting them anytime, and we're going to ask some questions that we got from attendees in advance. Again, I reach out to various people and ask them for their input, and hopefully that's one of the things that keeps the questions on point in this session, is that they all essentially come from all of you back to our panelists. So with public company multiples where they're at right now, they've certainly drifted downward. What does that do to your view of EBITDA multiples when you're buying companies? And is that really important? Is it really relevant what a multi-billion-dollar public company trades for when you're valuing a $50 million revenue operation? Mm-hmm. We'll rotate, but we'll start with LT.
It certainly matters. It's one reason. I know as independents, a lot of times you might open an article, and if one of the big public companies, has a rough time, you might, smile a little bit. But we're all kind of in this together. There's usually a reason that the large, publics would be, the multiples would be lowered, and that's because the industry's not in favor at the time, because they think we're either in a late inning of, close to a downturn, or that there's volatility on the commodity side that's going to cause all of us to be less profitable. When multiples become depressed, for the large companies, it happens all the way through the cycle. You might find somebody that's willing to stretch a little bit on a smaller business, but for the most part, values are relative throughout the industry.
Mm-hmm. So, I'd agree with that. I'll add a little bit of a different angle. If you think about one of the factors that go into how you think about what you'll invest in as an investor, you think about risk and you think about ease of getting in and out in that investment. With the multiples where they are in the public markets right now, any one of us can invest in our business, our industry, at a relatively low multiple with just buying public stock of BMC, for example. And tomorrow afternoon at, not tomorrow because it's Saturday, markets will be closed, but Monday afternoon at, 1:15, you can decide, I don't want to be invested in that any longer. That puts you in a very low risk scenario, and your return expectations are going to reflect that. Whereas obviously when we're doing an acquisition, we're making a very long-term not permanent, but very, it's a long-term commitment to a business. And so I think that risk component is one of the things that certainly tie public company multiples to private transactions.
I might have a unique perspective on that, being a public company up here, and a different unique perspective, because as I've joined the industry 6 months ago, I've watched public company multiples here compressed by about a turn over the course of the last 6 months. So it's certainly, to what Steve and LT said, I think it is a driving factor. However, I think it's a broader issue. An experience in other industries says it's more about, just like the markets don't like uncertainty. And I think, what we've seen in the industry here recently over the last 6 to 12 months is a lot of uncertainty. And I think that puts the public company multiples in context. And I think that is a driving factor as well. And I think the other thing, experience across multiple industries says public company multiples tend to set the cap for what you're willing to pay. And typically private acquisitions tend to trade at a discount to those public company multiples. That's just the reality and experience I've seen.
I guess the other thing I'd add is, history documents it, right? I mean, the correlation's very tight in terms of where the private company multiples go, as the public company multiples track from that standpoint. So, and totally agree with David that, the soft patch or beginning or last inning of the cycle, that uncertainty, is being reflected, I think, in the publicly traded multiples, but also, we're all, feeling it in our businesses every day over the last 3 to 6 months, for sure.
Okay. Our next question is, as you're out there looking at companies and looking at acquisitions, what are some non-traditional products and services that you've seen? We're all familiar with a certain core set of LBM products. What are some non-traditional or unusual products or services that you've seen that you thought were very successful, and especially if you implemented those in some of your locations? We'll go back the other direction and start with you.
Sure. In some of our markets, the penetration of components varies radically. In some markets, as low as 20% in terms of trusses, roof truss, floor trusses, wall panels. In other markets that we're in, as high as 95+%. So, the notion of investing and matching that manufacturing capacity with the demand, we're being very specific in terms of where we target it and try to do the right level of education to the builder customer to get the component side of the equation up even higher. So.
Yeah, I don't think there's anything new under the sun in this industry. I think you see all sorts of things in terms of services and, down to things like power tool rentals and all that sort of stuff. So I don't think there's anything new to be had there. What you see us doing is investing in value-added components, structural components, our millwork. We created the first of its kind automated truss facility just in the Atlanta market. We've announced several in partnership with MyTech, several additional facilities that we're doing that. So we're investing, through the cycle in areas that matter and we think will make a difference for our customers.
So I think we're a little bit unique in this. We're a more diversified business. We sell everything from rebar and construction accessories to the front end, the foundation contractors of a project, all the way to high-end appliances to the custom home builder right before that home closes and turns over to the owner. In between, we're doing what a lot of this group does in terms of lumber and windows and doors and trusses, as well as drywall distribution. So we see a whole lot of things going on, but most of those are in really focused distribution facilities, to that product category. What we've kind of seen that's been interesting for us is in some of our smaller markets where you see more of a general distributor that's touching a lot more of those products because it's not a market that serves has enough volume to really have all those specialty distributors, seeing how they bring all those products together and uniquely serve their market. That's kind of been something that's been a little bit more unique for us and fun to watch and look at and learn from.
Yeah, I think similar. We consider ourselves, very diverse, not only on the product side, but on the customer side. And I think because of that, it does lend itself to, to a pretty wide array of products and services by market. And there are differences by market. I mean, who buys it, what they buy, how they buy, can vary greatly by market. But, when you're selling remodel customers, you might be installing mirrors and hardware. For multifamily, it's going to be, a lot of big sales and, a lot of direct shipments. So it can vary greatly by market and by customer type.
Okay. Now, you four as professionals have experiences, especially Dave, in other industries. So one of the questions that came in was, what are some of the business efficiencies or best practices that you see in other industries that you've had experience with that you do not see in our industry, that our industry would benefit from being more like, that industry in that regard in terms of a business efficiency or a best practice? So we'll start with LT and work back.
Yeah, I mean, I'll go to the obvious place. I mean, technology, you hear about it every day, but, I think this industry is going to change more in the next 10 years than it has in the last 100. I think we're constantly investing and looking at what's next. When you think about just distribution, software, people used to, have clipboards in their dispatch office, so, one for each truck, one for each route. Now you can load, every shipment in, hit a button, and it'll optimize the routes. Reduce, number of miles you drive, the number of hours. So it's, they're just some very powerful tools, I think, that have come out of other industries that we're just now, kind of touching the surface on. But that'll really drive a lot of the changes in the future of our industry.
Yeah, I think technology is an enabler for inventory management, continuous improvement, all those kinds of things. The one that came to mind for me in this, though, is really more around people development. Our industry is incredibly driven and reliant on our people. And I think broadly from what I've seen in our space over the last 11, 12 years as I've been involved in this industry versus others that I worked in the past, was we don't spend enough time and energy and thought around really developing our people in most cases.
Those are both good, and I just piggyback on the technology point. We've invested heavily in e-commerce, mobile technology and capability, but from other industries, and I know we talked about this yesterday a bit, lean manufacturing principles, I see as maybe underpenetrated. Part of the cultural point that was attractive to me at BMC was the investment that we made in people and capability around developing that lean technology, and part of that's inside our company, but I think the real power in that is taking that to the marketplace, and partnering with our customers and looking at ways to take waste out of the value chain. And we're increasingly doing that work. The other point I just mentioned is and it links to technology, is automation. The investment that we're making in that, and innovation in general through our Ready Frame capability, our pre-cut, pre-packaged, pre-labeled framing solution for the marketplace, getting a lot of traction around that, and it really just speaks to the underpinning of an innovation we're trying to drive into the market.
They've covered great ones. Would agree with the lean manufacturing coming from still within building products, but the manufacturing background before distribution. The opportunities are still tremendous in lean deployment within the building material space. And the other one I would just share, and it's the underpinning of our strategic plan is that high performance organization. We need to continue to invest in our people. This industry runs 35 to 40% turnover rate. That's just a high cost of our business from a safety standpoint, product knowledge standpoint. So that investment in the people side is a strong underpinning that I think our industry still has a lot of room to move forward on.
Thank you. Next question is, you're obviously all active acquirers. How have the acquisitions you've undertaken impacted the profitability of your business or at a high level? Or how important are acquisitions to your future profitability, if you want to address it that way, however you want to cover it, the importance of acquisitions to your profitability?
Sure. Clearly, they are the center, core of our strategic plan. From this standpoint, as we build out our scale, we're doing that two ways. One, with the significant strategic tuck-in acquisitions within the geographies we're in, but if the scale's sufficient enough to add geographies from that standpoint. In the way of the profitability side, it really is the scale leverage that we're able to get largely on the supply chain side of the equation. You maintain the local brands, we maintain the local relationships, but it's through that synergy of largely on the supply chain side and the operational excellence that we're able to drive out of that.
I'd say they've impacted our profitability positively over time, and I think it's because of our approach and what we look to acquire are companies that bring in unique capability, either augmenting our value-added capabilities and services at or above the average profitability of our company today. Mm-hmm. And then we apply things like lean principles, the people development work, technology to just drive that improvement further. So we've been quite pleased with that work.
For us, similar to Jim, I mean, clearly it's been a core aspect of how we've grown our business and developed our business over time. I think that will continue. But certainly today, we've got 80 locations around the country that really is the core of how we grow day to day. But acquisitions certainly will continue to be a key part of that going forward.
Yeah, I think it's certainly an important part of our history and our future. But it's not the only way we grow. We grow organically, typically much faster than the market, and that's through taking share and through the use of technology and buying power and the things that we talk about. There's got to be more than you're not just selling your money, to monetize the business. You're probably doing it in this environment for competitive reasons, that you see advantages from, being part of a bigger company, whether it's buying power, access to technology, access to training, to teams. We run hundreds of training programs for management training across our company. Over 5,000 of our 8,000 associates have been formally trained in Lean, so we're doing hundreds of Lean projects. So after we do the acquisition, there's continued growth. Not only the first year, maybe it's more buying power the first year, but year two, just through best practices, through use of technology. I mean, it really is a partnership. The relationships drive the business on one side, but all these other things come to bear and best practices on the other. And it really does make it a good story for 2, 3, 4, 5 years and beyond.
With the possibility, as we've talked about in a few sessions at this conference, of a soft patch in the market in the next couple of years, and if you want to comment on what you think that possibility is, or your personal view of that, how do you approach valuing companies with the possibility more present than it might have been a few years ago that there could be a slowdown? How do you adjust your thinking? How does that find its way into you're sitting across the table? How did the market affect that conversation?
Right. Well, I think the teams you're dealing with are a fair amount of importance. We started our company in the middle of the worst downturn in the history of building in the United States. So we feel like we have a lot of discipline. We have a lot of insight on companies, how they manage those downturns and slowdowns. So we haven't stopped the idea that acquisitions are possible in this environment, even if it is a late inning. I hate to say it's a late inning because that means the game's almost over, but maybe we're heading, it's maybe the 4th or 5th inning and it's a little cloudy and we might have a little rain delay in 19 or 20. But I think at the end of the day, you're always ready to partner with great businesses and great teams that want to grow and want to, commit to things in the future together. So I think that's true in any environment. It's true now for us.
I think that's true. You're not going to see acquisitions stop, but certainly it impacts the value. It's a company that you thought was going to double in size in the next 2 years. From a valuation perspective, it looks a lot different to you than one that might be unchanged or even decline 10, 20%. So it has an impact, and it does make the deal conversations a little bit more challenging to find the right answer, but
Yeah, I'd agree. I think the whole conversation around multiples and the impact, late in the cycle, I think that applies here in a big way. Our approach is to continue to invest through the cycle, and we position ourselves in a way that we've got a great balance sheet. We're really doubling down in terms of driving organic growth, adding to the company with the right sorts of acquisitions, and certainly reinvesting in things like automation and technology. The other observation I would make, just coming in from outside the industry that might be a bit unique, is this industry, as you know, is very fragmented. But let me just give you a perspective from the outside on how fragmented I see it. So I grew up in the chemical industry where, the BASF, Dow, DuPont combination, the big three there had over 40% of that market. And it was still pretty fragmented, but it takes a lot of investment to put assets in the ground in that industry. Most recently, I came from food service, where at PFG we were number 3 in the market, and Cisco US Foods and PFG had about a third of the market. And I come here where the top 10 have 25% of the market. Mm-hmm. So extremely fragmented with all of the statistics that you showed, Mike, earlier. I still think there's a lot of runway around consolidation. I think we're in a great position to continue through the cycle.
Yep. Yeah, I would just echo what has been said with respect to the opportunities. They're still there. The fragmentation in the industry exists, and there's tiering where you look at the major metro markets versus the second and third tier markets. Not all markets are equal, and not all markets are reacting the same way in this soft patch kind of equation. So there's still clearly opportunity, for the right partnership. It's got to come, on a lot of other, critical fundamental points in terms of culture fit, and customer mix and those kind of things. But we're still aggressively looking, to the acquisition side for the growth of the platform.
Right. And that was sort of what you all covered off another question that we had in terms of the outlook for M&A for the next 5 years. Consensus is you're all still on the hunt. Absolutely.
We're bullish.
Continue to acquire.
Absolutely.
Yeah. So the next question, synergies in a transaction are talked about quite a bit. They're the sort of cliche of the 1 + 1 = 3. It's a question of who brings the synergy to the table, but they're the extra benefits that can come from the combination of two companies. In the deals that you've looked at, what are some synergies that usually come to fruition, and what are some synergies that you identified, not in specific situations necessarily, but synergies that are talked about that don't tend to come to fruition? In other words, what are the most attractive and viable and real synergies of acquisitions that you've seen, and which ones are elusive?
Yeah, for us, we're very focused early on the supply chain side of the equation, the ability to leverage the spend and create the right level of scale. And the other huge investment for us, again, we're the youngest platform company up here in terms of on the panel, the IT investment side of the equation. Each of our acquisitions so far have clearly and easily identified the need for significant IT investment in the ERP side of the equation. The systems are at the end of life of the companies that we have acquired, understandably, and so that investment is clearly in our sight and a key area that we're looking to invest from that standpoint.
Great.
I would agree with Jim around the sourcing side. Typically, you're buying, companies that are smaller tend to, have less scale, so you would expect and hope that, through your sourcing efforts, you can drive some synergy there. The other one, absolutely for us, is growth. And as I alluded to earlier, we're looking for unique capabilities in existing markets or perhaps new markets that can help us step change the growth. On the other side, to your point, I think, if you acquire organizations that are struggling or less profitable, thinking you're going to fix them, I think that can prove to be challenging. Those tend to take a lot of effort and sometimes don't turn out like you'd hope.
So certainly would agree with those. I think that the unique one I'll bring to the equation is collaboration. We certainly expect that when a company joins Kodiak, and we've got 20 or 25 businesses kind of in our portfolio, we certainly expect that that new company is going to learn some things from the team that we've got and working together and sharing best practices and ideas. But equally so, we're expecting that company, when they join Kodiak, is going to make the rest of Kodiak a lot better. So collaboration, though it's certainly not a typical synergy you think about, it's one of the things that we've really tried to foster through our company over the years.
Yeah, I think, the same here, purchasing best practices, lean technology, all those things, can bring about synergies, but we've also, found considerable synergy in product diversification. Because we're heavily into the roofing space, the wallboard space, some of the historically specialty products, most lumber yards that we would acquire or businesses that we would acquire haven't had the ability in the past to be in that. So we have a lot of synergy around new product sales, around new growth, around new products to new customer types as well.
One of the questions that we had, I think you all covered in part, was the notion of components and manufactured components. It seems that there's an appetite for that segment. There's a desire to add value-added manufactured components. Would any of you take the point that we're too late in the cycle to be investing in companies that manufacture components? Or do you all agree that, is it consensus that you're still forward on components?
We're aggressively investing, as I've said, and as you know, I would say maybe for someone that has not been in the component space, late in the cycle with some of the uncertainty, making that investment where you haven't demonstrated that competence and capability and market traction might be a bit risky, but in general, it's not too late.
Okay. Another question, and we talked a little bit about this earlier with the notion of centralizing some of the administrative functions, but obviously administrative functions aren't the only decisions that happen at the acquired company level. What is your company's model for the mix between consolidation of decision-making at the corporate level and autonomy down at the acquired company level. Jim, we'll start with you.
Yeah, in terms, and we had that question in the lightning round with regards to do we centralize or not. Our strategy and our approach is absolutely centralizing the back office side of the equation, but also centralizing the sourcing side of the equation. One, it's the way you drive the scale to the vendor side of the community. But the other key point to make, and I'll use just one of our divisions, where every location manager was responsible for their own procurement at the local level. In many cases, those individuals came up through the sales side of the organization. And when we did the deep dive and analysis, them spending time on the sourcing side, as an example, was taking just a tremendous amount of time away from them being customer facing from that standpoint. So here, just even in the early months, the feedback that we've gotten of pulling some of those tasks centrally has allowed the organization that's locally embedded in the markets to be much more customer facing from that standpoint.
Yeah, two things I would say is, first of all, we believe 100% in local market autonomy, and that's the way we run the company. Our field operations leaders are closest to the customers. We don't want to get in the way of that at all, whether it was through organic growth or through acquisitions. So we absolutely will keep that autonomous. I would say centralization is too strong of a word for even the back office stuff. The way I think about that is I would call it standardization of business processes and practices. Mm-hmm. So for instance, how we measure on-time delivery, putting in place some standard measures where you can kind of gauge success, and it really allows you to have a robust business conversation about driving improvement and how you're going to go about that. But
how about branding? Are you going to tend to
the
local branding?
We let that happen, locally. And what I found, again, unique for me being new to the industry, and I'm still meeting folks and traveling around. I've been to over half of our operations now. But the unique part of what I see is that autonomy plays out in different capabilities in our markets. And even, where we have production builders all around the country, they are asking us to do different things in different markets, and our offerings tend to be different even for the same customers.
Great, thank you.
At Kodiak, we're pretty violently decentralized. We want to empower our local leaders. Our role in our corporate office is really about allocating resources, allocating capital, supporting what they're trying to do, empower them, and then there's accountability to that, obviously. But for us, we launched this company very much with an approach that business in our industry is best done on the ground level, face-to-face with the customer, purchasing, even the supply chain component, very local, because the products and services that happen in a given market are very different from one place to another. So that's really been our model. We've got about 35 people in our corporate office. We certainly don't have enough folks running around there, nor are we smart enough to make all those decisions that happen everywhere from Florida up to Washington.
Yeah, I think, at the end of the day, again, it's about being the best in each market. We view our job as a corporate office to support that. But to gain the synergy of a large company, there are certain things you have to pull together, and that's, on the purchasing side, technology side. Once you agree on those things and agree on key metrics, then it's about just driving the business, working with the local operators. I mean, they do have their, they understand the market better. I'll just, don't want to reiterate what everybody else has said, but, there's a reason that you bought that company. There's a reason that each one of these companies make great partners for us. And that's that local knowledge, the way they run their business. So we just want to enhance and augment that. And, because they are entrepreneurs, the things we bring to them, they typically, they embrace it. They want it to be part of their business because they want to get better. They want to, take share from their competitors. They want a better price. They want to be able to go out and be more competitive. They want to be more profitable. So, I think, we're fully aligned throughout the chain.
Okay. All right, well, I'm going to switch to some audience questions now that you've all been kind enough to text to me. And we've had some speakers so far at the conference that have talked about the amazing technology that we have at our fingertips, and I would appreciate if we could make an agreement not to tell any of them that I have taken this high-tech device and I have written down the questions because I wanted this part to go a little quicker and me not be digging through these texts. So you've all asked some outstanding questions, and we want to get to as many of them as possible. So I'm gonna start with this one. How much time do you spend, and Dave, you've just indicated you've gotten to half your facilities, no mean feat with that many facilities. How much time do you spend walking your facilities And either walking the facilities or otherwise, when was the last meaningful aha moment you had regarding one of your operations? What was it centered on? What was the thing that you discovered about an operation you didn't know or realized, oh, we should apply that to some other operation we have, sort of the walking facilities and the aha moment? A two-pronged question. We'll start with Jim.
Walking the facilities, and again, being relatively new in the platform side of the equation, we did due diligence in locations, in every one of them. I physically was in every location we've acquired, before we acquired as mystery shopper and then after. And the aha moments for me were on the lean deployment side of the equation. Having some experience in that, we did it in my years at Stock in terms of the deployment there, just seeing some of the low-hanging fruit opportunities that existed, yards that still had a central strapping station, and the ability to make that very mobile. Just some very, very clear, immediate opportunities for us and the ability to share those best practices across the organization. So.
I'd agree with Jim. It's on the lean side, but specifically for me, it's workflow and the way that the facilities are laid out. And I think we're still in the early innings of learning that as an organization, and my point around all that is you tend to get into a routine and how you do things, and it's good sometimes to just step back with a fresh set of eyes or a new approach, like Bert has brought to the company around lean, to just question why you've always done it that way, and is there a more effective and efficient way for folks in the company to do their work.
Absolutely.
I think, my latest aha moment was yesterday afternoon at lunch. Greg Smith, who runs our golf and basketball operation, is here with me, and we were having lunch, and he was telling me about some things going on there at Golf and Basco, and I walked away from lunch going, man, I'd love to work for a guy like that. The way he's treating his employees and the innovative ways he's supporting them and encouraging them. And I'd run through a wall for a guy like that, and I'm sure his team is doing that. So that was something I took several things away that I'll go back, and when I'm on the phone with other folks or out walking the yard, say, here's what's going on down in Houston. What would that look like in your operation?
Nice.
I think I've been in this industry, my entire career. So I feel like I've walked thousands of lumber yards, both ones ours and others. But every time I walk through, there's always something. And I think the last aha was actually, on the safety side about, just everybody wearing, the same vest and having our first year people wearing a different color. I think it's just a great safety idea, so everybody knows who's who and who's the new person that's likely to maybe make a mistake or do something you're not expecting. But I think for me, I find value. We have hundreds of training classes, and lean classes, every week. And when I get to sit into those, the real ahas that every answer, for our company, are in those meetings. The people have the answers. We just need to make sure that we have enough, lean projects to bubble those up to make sure that we see what's possible and then make sure we make it a best practice across the group. That's our biggest opportunity.
Right. So this I thought was a great question. If the statistics say that roofing, drywall, and lumber drive M&A in the industry, what's the future look like for those three channels to merge and have it be more likely that there aren't mega drywall only companies or mega roofing only companies, the convergence of those three channels, drywall, roofing, and lumber? LT, we'll start with you.
Well, you can tell by our strategy. We absolutely believe that, that customers want to buy from one company. If you've got the right technology, the way to interface with the customers, and you can do it, if you can do each segment as well as the specialty dealers, there's no reason they wouldn't buy everything from you. So that's why you've seen us invest heavily, in wallboard roofing and also the full line lumber. If you're going to sell everything to a builder, you have to offer everything, right?
Well, I talked about our diversification earlier. It's certainly our philosophy has always been, since we started in 2011, that at a high level, whether you're getting drywall to a job site or roofing or lumber or frankly some of the other products I mentioned that we serve, those same core principles that make you successful in a lumber yard make you successful in a drywall operation, and on and on and on. So that coupled with being a very decentralized business, we've always had the philosophy that why wouldn't you bring all those things together? And so I think we've seen over the last 5-10 years increasingly that being adopted. We're seeing, certainly, as LT said, some of these categories at a very major level come together under one umbrella. I think that will continue.
Nothing really unique to what's been said already. I think you will continue to see consolidation as folks look to augment their offering and become more of a one-stop shop. I think, that sort of consolidation will continue to make sense.
The only dimension I'd add is, many of our locations are in smaller markets, not in the top 25 major metro markets and the like. And so the ability, we've got drywall, we've got insulation, we've got roofing in those markets. Because again, just because of the size and the markets and the customers that we serve, to LT's point, the builder does enjoy the opportunity to buy everything they need from one location. So for our footprint and our strategy at the custom home builder, professional remodeler, having that full assortment is an important opportunity.
Okay. So another question that we had was, you're all active buyers. Are you ever chasing the same company as each other?
Oh, sure.
And I'll add to that, how does that affect your behavior if you know you're, shall we say, not alone in the tent?
Well, I think the answer probably for all of us is yes.
More often than not, likely.
More often than not. And that's because the bankers in the room are doing their job in terms of, making sure those that are particularly interested have the opportunity to see what's available from that standpoint. Does it change? It certainly doesn't change in any way our strategic criteria in terms of culture match, product mix, and very critically the customer mix side of the equation. But there's very rarely just a one-off opportunity.
Yeah, I would agree with everything Jim said. I think if you can find those opportunities where it's not a competitive auction, and you work on those through building relationships and do more of an outreach internally versus waiting for it to be brought to you, you've got a better chance of that not being competitive. But I also agree that you got to do your own thing. How you value those businesses, whether it's the right strategic fit for you or not, and then just make those decisions based on what's right for your organization.
Okay.
Certainly we all bump into each other some in deals, and but does it really change our perspective and our approach? Absolutely not. In fact, I would tell you, I just met Dave yesterday, but I've known Jim for a long time, known LT for a long time. I'd love to be able to go into an acquisition conversation and say, that Jim guy, he's horrible. You don't want to have anything to do with him. We can't say that. They're great guys. They're good friends. We respect them. And frankly, there's people in this room that, from a culture perspective, which I know is vitally important to us, that cultural fit of what we're trying to do and how we're trying to do it, and what you're trying to do in your business and how you're trying to do it. Some of you would connect great with Kodiak. Some of you probably would have a better fit with Jim or Dave or LT. And I think one of the key successes to a deal is really about having that cultural fit and finding the right home for your employees and your business and your philosophies about how you do business. So I certainly think it's a good thing that we all bump into each other some in those, because you as a seller are able to find the right place for your people.
Yeah, nothing different. I think it's really important that, that when you're selling the business, you find somebody that's committed to the same things that you are. Even if you're going to leave the business, you're still not just going to sell it, for the highest possible price and leave your employees in a situation that's not good for them. So I think doing due diligence there, and, again, I think, you've got 4 great companies up here, and there are many more out there. So you'll have a lot of choices, and I think you find the right fit for you and your business and your people. And I think at the end of the day, that's good for us and good for you too.
So in the interest of time, let's knock out 2 questions that are sort of quick yes or no type questions. When you buy a company, do you require E-Verify on all the employees before you take them into your company? Is there an E-Verify filter? Do you require that?
We use E-Verify, but not on past employees. All employees for a company become, however long they've been with you, they get the same tenure with us. So if they're a 7-year employee, they're a 7-year employee with us. They'll be in the day we hire them.
No, E-Verify meaning...
Right, I know, but we don't go back and we're not
Don't
going
go
to
back.
E-Verify our own 7-year employee, and we're not going to do yours either.
Oh, I see.
That's what I'm
Okay.
saying.
We use E-Verify for new employees. So when it comes to a deal perspective, it kind of depends on the structure of that deal. If it's an asset deal, structurally, we've got to go in and hire those employees as new employees. We do the same thing from a tenure perspective. But so in those cases, yes.
Yeah.
But as LT said, existing employees, we're not doing that.
Same.
We do.
Yes, okay. And another relatively quick question. a lot of these businesses have family-owned real estate within them that's a key asset of the company. Are you wanting to acquire real estate so you control your own destiny in that regard, or are you not wanting to acquire real estate, meaning they probably have to sell it to a third party? Right. Buy real estate or no, don't buy real estate? Our
preference is not to, but we, in every situation that arises where that occurs, we facilitate the parallel transaction with a real estate firm. Then we take the leases from there. So we can accommodate either situation.
Same for us. I mean, it really depends on the individual deal and what the owners are looking to do. But we're not afraid to buy the real estate, if that makes sense.
Okay.
Yeah, we don't own any real estate at Kodiak. We look at every deal uniquely, but our preference is to lease.
We're flexible. We're happy to do whatever works best for you. We probably will resell that real estate at some point to a third party and do a lease because we'd rather take our money and invest it in other things than real estate. But we'll work with whatever needs to happen to make the deal work.
Okay. And so piggybacking on what Steve alluded to earlier regarding culture, one of the questions that came in was, what are the specific as you can be, cultural aspects of a company? Culture fit is a little bit of a cliche. What are some of the specific cultural aspects that you look for, or maybe characteristics of a company that are symptomatic of strong or weak culture, things that let you know you're getting the right culture and let's go forward with the acquisition, or we didn't do that, they were the wrong culture? What are the reasons?
It's amazing how much you can see culture even on a P&L. The right culture, is obviously one of growth, one of operational excellence, how well they manage, inventory, the fleet. If you have a great culture, you're usually good at everything, and that comes through really easily on a financial. If it's just a business where someone owns it, they've just had it forever, they're not really involved, and it just kind of floats along, that's pretty obvious as well. So, you can see the great aspects of culture right from everything from the people you meet right through the P&L.
I think it's hard to put the term, great or bad culture onto something because everyone's got their own unique culture, and what works for you or what, the way you want to run your business may not be the way one of us up here wants to. That doesn't make your culture bad or good, or ours that way as well. I think it's about knowing what you are and who you want to be as a company, and then making sure that there's going to be alignment there. We've done a couple of deals over the years where there wasn't alignment, and that is a very difficult and frustrating and complicated transition for both sides. It doesn't work very well usually. It's pretty tough to change culture in an organization. So what do we look for? We wanted to build a company that really valued its people, really cared genuinely about its people, and created a great place for them to build a career and take care of their families. As I talked about empowerment and a locally driven culture. We want people and organizations that are really going to take the reins and want to grow their business and want to succeed and thrive in their local markets. So those are the things that for us define a great culture, but it's great because that's what we're about and what we're trying to accomplish. Not because any way anyone else does it is bad or wrong.
I'd agree with what's been said here, but what I would point to is the core values of our company, which start with people. And putting people first, not only finding the right people, but investing in them and developing them over time, making customers a priority, to the point LT made around growth culture. That will fit well in our organization, and the innovation push, integrity. That's a very important core value for us. Continuous improvement, always looking to find ways to improve your organization, yourself, as individuals, and safety. Those are our 5 core principles, and that really drives the culture of our organization.
They've hit on it. The one I would emphasize that we spend a lot of time on is that people development side. Is there a recruiting program? Is there a management training program? Is there a co-op program? And then how does that all get integrated into safety as a critical core value? We're in an inherently risky business. Heavy equipment, heavy materials. That safety side of the equation. How the company has addressed that is a key criteria for us going in.
Okay. So a question we've had, and I'll start with you, Jim, on it, but I'll ask everybody the same question. When you are the successful buyer of a company, we agreed earlier, you're all looking at deals at the same time and have competition for a deal that you would undertake. When you're the successful buyer, was it because you're better at assessing the risk and value of that company? Or did you overpay?
Well, hopefully not the latter. From that standpoint, I think at the end of the day, this is a relationship. We keep using that word, and so many industries say we're a relationship-based industry. This is a relationship-based industry. Okay, the majority of people in this room have been in this industry, their entire careers. So when in the conversations that we're part of, the owners. And as we said, may want to stay with the business or may want to exit it, but they want it to be with a company that their associates, their employees, have a very good fit and a very good future for. So I think, in many, many cases, it becomes an alignment of that. Then there's certainly a negotiation on the dollar side of the equation, but if that match isn't there, from the seller side of the equation, I think that's the foundation that gets us across the finish line to the deal.
I'd agree with Jim. I think the culture point and what we've just talked about drives the majority of those outcomes. Yep. Many of these businesses are family-owned, multi-generational, and while they're looking to drive a disposition of their business, what they care about is their organization and what they've spent their entire life and certainly sometimes many generations building. And so it matters. They care about their people, they care about the future of the organization and what's going to happen going forward. And we find that is really the most important point.
Yeah, I think when we win the transaction, we win it because we've done a great job communicating what we're about, and we found that alignment of all these things that these guys were talking about. The question of whether you've overpaid or not, I think you find that you don't know that for several years until you see where things play out.
That's true.
Yeah, I think for us, if we're successful, it means Mr. Hooper's done a great job explaining to them what we're all about, explaining our culture, using the 54 that we've done as our commercial and letting them talk to those people. If we didn't get it, it's probably because one of these three guys overpaid.
The advantage of going last.
That's what I was saying. I got to take that.
Well, so I think we've covered all the questions on the app that I can see. I apologize if I didn't. I'll try to circle back some of them. We've got 3 minutes. Can you just give me your Cliff Notes version of your outlook for the market? What's the next few years look like? Good, bad, and different? Recession coming, not coming? Just your quick assessment of the market. Jim?
Don't anticipate the R word to be used 12 or 24 months from now. Probably a bit of an elongated soft patch is how I'd describe it, but don't see it as anything that we would look to and say within residential construction we were in a 18 or 24 month recession. I don't see that.
Yeah, we're bullish, right? And even for this year. If housing starts are flat, it's still going to be the second or third best year in the last decade or more, for housing starts. And that really plays to all of our strengths and what we're trying to do. We're bullish near term and even long term. And, the fundamental things, the economy currently, but more importantly, demographics, population growth, all that stuff is still there. And the things that drove the Great Recession, a decade ago, those things aren't what's driving any near-term slowdown in the economy. So.
Thank you, Steve.
I think as we've been talking about, this is a local market. So market by market, it really varies. I mean, we've got places that are probably seeing a little bit of a pullback to markets that are still rapidly growing and everywhere in between. That being said, I think at a macro level, we're expecting it to be certainly much more moderated growth from what we've seen for the last several years, but as these gentlemen said, still really strong believers in the long-term outlook, and will continue to be looking to grow.
Yeah, I'd agree. The longer term, the macro indicators say that this industry is going to, it's going to do well for years to come. We may have some blips along the way, but I still get up every day really excited about not only the industry, but our company, the things that we're doing, as a company on the technology front and others. And I think when we do hit those little soft patches, when you lose your tailwind, great companies take to the oars. So, we're all on the rowing machine getting ready.
Yeah. Well, good. Well, listen, in closing, I just want to thank all of you again for being here, and we appreciate our relationship with ProSales and our opportunity to come up here and chair this session. And really, this session is one of those things that is indicative of how great an industry this is, because you get to come here and have firsthand questions and dialogue and information with some of the top companies in the industry. And it's really one of the great rewards of coming to this conference. So we appreciate being a part of it and appreciate that ProSales makes that possible. Want to thank all of you for your questions and for your attention, and certainly thank our panelists for their great participation and thoughts and ideas today. Thank you so much. I really appreciate it.
Thanks a lot. Enjoyed it.
Thanks.
Good job. Appreciate it.
Thanks, Dave. Appreciate it. Sure.
Thanks.
Nice to meet you.
Thanks so much. I appreciate it.